This is the time of year that we're all looking into 2020 and trying to figure out what are the major themes going to be in 2020 that are going to really drive our investment decision-making process. The analysts at Bloomberg Intelligence, with 300 of them, that have gone and worked with Business Week to try to figure out what are the 50 companies that we want to be watching closely into 2020 that we want to be paying attention to. And what I would like to look at today is say, what across the 140 industries that we cover, what are the major themes that we are looking at, basically bucketing them into different themes. We have roughly almost 20 different themes that we're paying attention to as a department. And interestingly, the single biggest theme that I've bucketed here is restructurings and turnaround. This is always an interesting trend that everybody pays attention to, but in general, we see this going on more and more today than we've seen at any time in the past. U.S.-China trade war. Of course, that is an enormous issue. All our analysts are talking about it, and it is impacting a large number of the 2,000 companies that we as a department cover. Over the course of the day, you're going to hear from a number of the Bloomberg Intelligence analysts talking about different themes in their specific sectors. Starting with, in a couple minutes, I'm going to have one of our energy analysts up to talk about themes in energy. Streaming. We have another one of our media analysts coming in talking about streaming. That's something that affects every single one of our lives going forward. And then technology and telecom and the convergence of various technologies that are going to drive the way we live and the way businesses operate. And then I think earlier today, we talked about healthcare innovation, obviously enormous and a big area of focus for Bloomberg Intelligence. Let me start by talking about the China trade war, and I'm going to talk a few minutes about that. Something that everybody talks about. It's in the headlines all the time. I want to step back and look at this and say, 30, 40 years ago, it was the U.S., Germany, and Japan. China was nowhere to be seen. Japan was the big concern at the time. Today, clearly, China has taken the place of Japan, grown enormously, and really what you see is whether you're looking at exports or imports, there are three major world-dominating trading partners, and that's China, the U.S., and Germany. And when you look at the two largest of those three, really at war with each other in trade, it is going to have a big impact on everything we're thinking about in 2020. And let me just talk about China specifically, and then I'll talk a little bit about the U.S. The obvious on China is, yes, their vulnerability is how much they export to the U.S. Big issue, and we all know that. On the positive side for China is they're actually pretty well diversified on their imports, and so that helps insulate them a little bit. But yes, they do have a lot of vulnerabilities that relates to the U.S. exports. On the U.S., again, the obvious is how much the U.S. imports from China and the dependence on those imports. But one of the things that I would point out, that helps the U.S. out is that a lot of people don't understand just looking across the borders and looking at Canada and Mexico. Believe it or not, whether you look at imports or exports, Canada and Mexico are far more important trading partners to the U.S. combined than China is. And then there's the politics of soybeans. Okay, everybody hears about soybeans and the farmers, and this map is an interesting map because it has wheat and soybeans in pink and green dots. You'll notice they are heavily in red states, Republican states. Clearly, China recognizes that. That is a pressure point for the U.S. political system, and and fascinating to look at. I made a presentation about trade 2 years ago, and a lot of our analysts talked about how difficult it was going to be for China to wean itself off of U.S. soybeans. Well, we proved wrong. Soybean imports into China down 70%. The thing that's even more surprising is we thought that Brazil would take up the slack. Well, Brazil's exports to China are also down significantly. So they've retooled their economy to be less reliant on soybeans. Now, let's go back and talk about the grievances that each country has. Both countries have legitimate grievances. And we just talked about soybeans and wheat. Agriculture subsidies are a big issue for the U.S. and something that I think China gets frustrated about. But really, the bigger issue are the technology issues. All of the grievances between the two countries are about a war over dominating higher tech industries. And this was made really, really clear when China announced its Made in China 2025 initiative. This initiative did not talk about clothes. It did not talk about shoes or toys or furniture. It talked about advanced information technology, rail transit systems, power equipment, and even biotech. Nobody thought that China would be looking into the biotech industry, but our healthcare analysts are paying attention to China's impact on that. Now, this starts to affect the 50 companies that we've identified. And a number, I'll give you a few examples. If you look at robotics, and you look at Nidec, which is a precision motor company, and dependent on supply from China, they have started to systematically start moving their production into Mexico. So a great example of one of those top industries that China focuses on, and decisions being made to retool their supply chain. If you go into new energy vehicles, another example, we start bringing in Cree, who is a big important semiconductor into the new energy vehicle market. And if we go to 5G with Huawei, everybody knows the controversy over that, but this really affects the entire supply chain. You start with Cree that makes semiconductors basically for the supply chain around Huawei. They're hoping to have a $9 billion market grow over the next 5 years. Those blocks on Huawei really threaten the ability for that market to grow to the size they had hoped it would be. On the flip side, you have Samsung that's approached the market very differently, and they have chosen to not be as exposed to supply chain in China, unlike Apple. And then you look at the top of the supply chain, the actual service provider, you look at British Telecom, and British Telecom in Europe is really dependent on Huawei for its gear to build out its 5G network, unlike the US. So their time to market for 5G in Europe, which was actually behind other parts of the world, is only going to be more extended because they were planning to rely on Huawei technology. And here again, I have an example of Samsung versus Apple and their supply chain. You can see the significant number of supply chain points that Apple has to China. Samsung has really taken a very, very different approach. And then so to sum this up, what I think is important to note is, as we expected, imports to the U.S. from China are starting to decline, and starting to decline quite significantly. Mexico's picking up some of the slack, as I said, with Nidec, but even more importantly, places like Taiwan and Vietnam are significant. So with that, I want to bring up three of our senior analysts to talk more about trends and themes in their own various industries. So I've got Mandeep Singh in technology, Fernando Valle in energy, and then I have Allison Williams in financials. Mandeep, I'm going to start with you. You and your team have talked extensively about what is going on with the convergence in technology and how that can change our lives. And of course, I've talked about 5G and the China-U.S. trade war. Tell us, what are you thinking right now?
I mean, nowhere is the trend of convergence more visible than the trend of cloud, where hardware and software has come together, and it's allowed companies to outsource their infrastructure in a way where they can save IT costs, and really made it easy for companies to innovate. So our view is cloud is now about 20% of the total tech spending. So we're talking about $2.3 trillion spent on IT spending every year, and cloud is about 20%. And what it has done is not only created companies like Amazon, Google, and Microsoft on the public cloud side, but also it's created opportunities for hardware companies like Nutanix, which is one of our featured 50 companies for this year, to really kind of build a product where companies can offload their workloads and really build a better mousetrap, if you think about it that way. And even though it's still relatively small, we feel, it's one of the companies to watch out for.
And Mandeep, in terms of disruption, where is cloud becoming most disruptive in your view?
Yeah, so that's a great point. Cloud is really allowing a lot of innovation in the economy, and gig economy is one place where you see a lot of innovation all of Uber's infrastructure is built on cloud. There are companies like Just Eat. So Uber and Just Eat are two of our featured companies for next year. And even though they haven't really figured out a business model, but when you look at ride sharing as a percentage of overall travel, it's about 6% now. And you can see it's ride sharing as a percent of travel is growing at 40% in contrast to the overall travel market, which is mid-single digits. So these companies are actually creating new use cases for consumers. You can see the use of ride sharing on the airports for healthcare kind of use cases. And our view is, even though the business model isn't very clear on the gig economy side, but you know the use cases are emerging and consumers like to use the on-demand services, which is where the convergence is, on the on-demand side and mobility side and the resources it's unlocking. And I want to end with the 5G part of it. So 5G is really a wild card, but we think it can help accelerate the deployment of some of these technologies, because at the end of the day, if you want autonomous cars or new monitoring machine-to-machine use cases, you really need 5G stations. And AT&T and T-Mobile are two of the companies we have featured in our 50 companies, and they are investing a lot of their CapEx in 5G, and they're building a lot of base stations there.
Thank you, Mandeep. Fernando, let's turn to the energy space, totally different area. But you and your colleagues for the last decade have talked just constantly about the shale revolution and how that has changed the political dynamics and the world supply of oil and natural gas. Is that revolution sort of slowing down? Is it coming to an end?
It's definitely slowing, but it's not ending. Shale perhaps grew too fast for its own good, and we're seeing some of the shakeout now in the U.S. side of the equation. But what's really important is over this year and the next, we're building the infrastructure necessary to take that revolution global. And that's really having an impact on oil and gas prices internationally and allowing for a lot faster development. So we, as a rule of thumb, we think that if energy is about 5% of global GDP, it's accretive to overall demand. And that's just about where we are today at $55 to $60 a barrel. And that allows you not just to foster faster growth, but also to take on new policies and everything else. And as we build out this export capacity, particularly two of the companies that we highlight are MPLX and Enterprise Products, we think we can really keep that oil price low as we add more supply to the global economy.
So with these low prices, doesn't that hurt the innovation in renewable energies?
It definitely raises the bar. If you consider, for example, electric vehicles, when oil prices are $50, $60, it's a much bigger hurdle for you to buy an electric vehicle as opposed to an internal combustion engine vehicle. When you look at the emerging market economies, they still don't have a reliable electric grid, so it's much more costly for you to make that switch. But it also enables you to put on more policies that reduce our overall greenhouse emissions. So for example, this low natural gas price, you can see on the chart just the precipitous drop that we'd had and the impact on demand. It enabled China to start to switch from coal to gas. It enabled the UK to say they'll close all coal plants by 2030. And it's now enabling us to lower sulfur emissions as well. Next year, we're going to start with IMO 2020, which is a cap on the total sulfur for fuel in the maritime industry. And we expect it could extend into other industries as well, where you have lower sulfur caps in U.S. gasoline that's likely to go global over the next several years, and potentially even for jet fuel, which is a high sulfur fuel that's consumed everywhere in the world.
All right. Allison, let's turn to you. First thing I mentioned in this presentation was so many companies are going through restructurings and turnarounds. I'm assuming that the financial industry is not an exception to that.
So it is interesting, the number of restructuring and turnaround companies in this year's 50, and particularly how many of those are financials. But there's also no U.S. banks, which is another thing that sort of caught our attention. And why is this? When we think about why that might be, we think about the trend in profitability. So we're operating at the high end of profitability for the industry for some time, which shows that we are late cycle. And so given this, it's not surprising that we sort of turn to unique corporate stories for opportunities.
So I'm guessing that in the 50 that we identified, there were a few in the financial industry that fit that restructuring turnaround bill.
There were. And so, as I said, the U.S. banks have really done a good job in terms of healing themselves since the crisis. But within insurance, there are a couple of companies that we think have trailed over the last decade or so, but may see some improvement this year. So the first is European life insurer Aegon. We do think a management change there with a new CEO that just comes off of some success in turning around another insurer. We think he's going to come in May and he's going to get the job done for Aegon. In the US, we have AIG, another troubled insurer. New management there, Brian Dupereau. He's a turnaround specialist. He's already made progress in changing the culture and operations, and we think that's going to accelerate in 2020.
What about M&A? I mean, M&A is sort of in the category of restructuring. Are we seeing much in the M&A space?
So M&A is a theme that we think across the global financial team is going to be an important one for next year. But we want to see not just deals, but the right deals. And so 2 companies in the 50 we think highlight this issue. So Global Payments is sort of the biggest fintech that consumers have never heard of because they focus on business to business. They have a history of executing well on transactions. We think that there's upside to the deal that they did with Total Systems, the company they purchased this year, on the cost side, but also revenue, which is a little bit more unique. And then secondly, by contrast, we have Standard Life Aberdeen. This is a combination that has continued to see outflows since the 2 managers combined. Granted, part of that's the environment, but if they can't improve that, we think that, our analyst thinks that they could get broken up.
Okay. Let's talk about, you mentioned the asset managers, and one of the things I think we hear all the time is ESG. It's a growing topic outside of Bloomberg, inside Bloomberg, within our department. And we're seeing the asset managers, more and more money is being mandated, and we've seen massive growth in money being mandated under ESG standards, or at least part of the investment process. What are you seeing in the companies that you cover?
So I think while all the banks and asset managers will face pressures to do better on ESG and are looking to do better, we think that managed assets are the way that they are going to drive change in terms of both direct mandates and incorporating that in their investment processes. Clients are demanding it, and they in turn will demand it from the companies they invest in.
Okay. Fernando, on the E of the ESG, your industry is sort of in the crosshairs, isn't it?
Yeah, we're definitely the big bad wolf in the E side. And I think as Allison said, client demand is really the crux of the issue for big oil. And it's incumbent upon the industry to show that they're part of the transition and not just a problem. So they're trying to reduce their carbon emissions. Chevron announced an emissions target, reduction target over the past year. Several of the companies are trying to do remediation as well, be that through planting new forests or just by investing in wind and solar, particularly the Europeans. And then new technologies. Exxon, for example, is trying to pioneer algae as a fuel to replace fossil fuels and carbon sequestration and storage. So if they can really build on that and convince the public that they're part of the transition, not part of the problem, just part of the problem, they can actually stave off some of that outflow.
Right. Great. Mandeep, in the last few seconds we have, anything from the technology sector on ESG?
I'll quickly focus on the G, governance of the ESG. And tech companies are notorious when it comes to voting rights for the CEO and the founders. What we saw this year with Uber prior to this management change is obviously they had to do away with the dual voting rights. We saw something similar with WeWork recently. And I think the appetite for, founder-led companies having dual voting rights is kind of going away now. And you will see investor scrutiny around dual voting rights with some of the IPOs that will come in the market in 2020. So that's really our prediction. Let's see what happens.
All right. Well, Mandeep, Fernando, Allison, thank you very much. I hope everybody found some of the insights and the thematic work that we've been doing in 2020 at Bloomberg Intelligence helpful. For the next 20 minutes, I think we're going to have a break. The 4 of us will be out to talk if anybody wants to discuss any further. But we'll see you back at, I believe, around 11 o'clock. Thank you.